Have you ever felt your chest tighten and let out a weary sigh when you see the notification for your loan interest or this month's credit card bill? The monthly interest payment that used to be just 100,000 won has now skyrocketed to 200,000, or even from 500,000 to nearly 1 million won. That suffocating and helpless feeling when looking at those numbers is probably the painful shared sentiment of most households in South Korea right now. According to official data from financial authorities, the average debt per household is now approaching the 100 million won mark. However, that's just the average. In reality, many people are burdened with enormous debts of up to 300 or 500 million won. Amidst this landscape of debt, the financial market is flashing an extremely terrifying warning signal about the near future. It's a signal of a tsunami of interest rate hikes in 2026, something we have never experienced before. Today, we will delve into the truths that news reports often overlook, but which the bond market and exchange rates are screaming warnings about. There is a rather uncomfortable truth you need to know. We often think interest rates only change when the governor of the central bank makes an announcement. But in reality, the savvy sharks in the bond market have already sensed where the money is going and acted even before the central bank. If you look closely, South Korea's 3-year government bond yield has now far surpassed the 2.5% base rate. This figure has broken the 2.87% mark and has continuously maintained an upward trend for the past 6 months despite current policies. This means that investors are betting their money on the certainty that interest rates will have to rise in the near future. While the government is still cautiously deliberating for political reasons, the smart money in the market has already priced in the upcoming risks. In complete contrast, in the US, bond yields are lower than the base rate because they are preparing for a path of rate cuts. We are witnessing a dangerous decoupling phenomenon. The US is preparing to lower interest rates, while South Korea is being forced into a position where it must raise them. The core reason for this ironic situation is the extremely tense developments in the exchange rate. The 1 USD exchange rate is currently hovering around the 1,370 mark, and fears are spreading that it will break through the 1,500 mark by the end of the year. If the exchange rate hits 1,501 to $1, it would truly be a horrifying disaster for our economy. The prices of gasoline, flour, meat, and all imported goods will skyrocket, causing the cost of living to escalate to an uncontrollable level. In the past, they could keep interest rates low to support a weakening economy, but now the exchange rate is spiraling out of control. We're being backed into a corner, forced to raise interest rates to halt the disastrous slide of our local currency. Even if the US starts cutting rates, South Korea can't simply follow suit because the interest rate gap between the two countries is already too wide. If we were to lower interest rates now, a massive outflow of foreign investment capital would flood out of the Korean market like a bursting dam. Another frightening sign is quietly unfolding at bank counters, a detail that few have noticed. On average, nearly 1 trillion won in cash is vanishing from the bank deposit system every day, a record-breaking figure. People are rushing to close their savings accounts to chase the high-risk investment frenzy in stocks, cryptocurrency, and real estate. As deposit vaults empty out from customer withdrawals, banks are facing a severe capital shortage to sustain their lending operations. To cover this deficit, they are forced to issue bank bonds at extremely high interest rates to urgently raise capital from the market. The rising cost of capital for banks means that lending rates for the public are also being pushed up at a dizzying pace. This is the nightmare scenario for the 2026 real estate market that we must face head-on. Recently, the government announced a GDP growth of 1.2% and used that rosy figure to reassure everyone that the economy is fine. But don't be fooled, that's just an illusion created by the export profits of a few giant corporations like Samsung or Hynix. While the big players benefit from the exchange rate, small businesses are closing down in droves and the real income of the people is shrinking. The polarization of wealth is more severe than ever, and these average figures are hiding the pain of the vast majority. The central bank will very likely use this GDP is still good excuse to aggressively initiate its interest rate hike schedule. They will argue that the economy can withstand it, so the top priority now must be to rein in inflation and the exchange rate. So, in the face of this colossal financial tsunami hurtling towards us, what must we do to avoid being submerged? If you just stand still with wishful thinking, you will be swept away by the vortex of bankruptcy when the interest rate hikes hit. Right now, remember, and immediately implement the following 3 critical survival strategies. First strategy, turn your cash flow into an impenetrable fortress where nothing gets in and nothing gets out. Open your banking app or spending ledger right now and scrutinize every single penny flowing in and out of your account. You must find where the money is leaking, no matter how small the hole, because small leaks sink great ships. Ruthlessly cut all non-essentials. Cancel your Netflix and YouTube premium subscriptions. Downgrade your phone plan and stop eating out. If your income minus your expenses equals 0 or is negative, consider it an urgent code red situation. In that state, if interest rates inch up even slightly, your family will immediately face default. You must build up enough cash reserves to survive for a minimum of 3 to 6 months in case of an emergency. Second strategy, implement the strictest possible debt diet. There is good debt and bad debt, and your first task is to eliminate the toxic debt. This is why mortgage rates have recently surpassed the 6% mark, even though the central bank has not announced any increase in the base rate. The market is experiencing a true tightening squeeze, ignoring any reassuring or placating signals from the government. When this real interest rate storm collides with the 2026 timeline, a true debt bomb will be triggered. Those in the greatest danger are the ones who maxed out their loans to buy homes during the peak of the property boom in 2020 and 2021. At that time, they secured loans with incredibly low interest rates of just 2%, along with a fixed rate offer for the first 5 years. Let's do some simple math 5 years after borrowing, and 2021 brings us to the fateful year of 2026 we have been discussing. That is when the protective shield of fixed interest rates disappears and they are left exposed to the market's sky-high variable rates. The monthly interest burden will not just increase slightly, it could double or even triple from what was originally planned. Imagine a monthly interest payment of 1 million won suddenly becoming 3 million won, devouring entire incomes and plunging families into dire straits. Remember, paying off a loan with 10% interest is the most guaranteed way to make a 10% return on your investment. For those with variable rate mortgages, consider refinancing to a fixed rate even if you have to pay a prepayment penalty. Never be complacent and think, it probably won't go up anymore. That thought will erode your assets day by day. In these turbulent times, reducing interest expenses is more important and effective than any other form of profit-seeking investment. The third strategy, restructure your investment portfolio. Never put all your eggs in one basket, be it real estate or stocks. When interest rates rise, the value of risky assets will certainly decline, and at that point, cash is king. Look back at 2008, those who held cash were able to acquire valuable assets at giveaway prices. Allocate a portion of your assets to safe havens like gold or the US dollar to hedge against currency depreciation risks. And more important than money, invest in your own survival capabilities and professional skills. Even if your company goes bankrupt or the economy collapses, excellent work skills will be the only life raft that keeps you afloat. Remember, 2026 is not as far away as you think. It's hurtling towards us at the speed of a high-speed train. An exchange rate of 1,501 or soaring bond interest rates are not just lifeless numbers on the financial news. They are the blaring alarm bells that the market is sending directly to your wallet and your home. A crisis will be a disaster for the unprepared and lazy, but a life-changing opportunity for those who are ready. Don't let fear paralyze you. Start taking action from the smallest things today. Paying off 100,000 won of debt or saving an extra 10,000 won in spare change are all monumental steps. Those small bricks, when accumulated, will build a formidable fortress to protect you from the coming storm. Be sober, be decisive, and act now to master the financial destiny of yourself and your family. Thank you for listening. I wish you strength and peace to overcome this volatile economic period.